For years, Bitcoin was the Wild West of finance, risky, volatile, and dismissed by Wall Street. But in 2025, everything changed. The biggest names in finance are now diving into Bitcoin. This isn't a small trend, it's a seismic shift, and it all started with 3 letters: ETF. Suddenly, institutions that once mocked crypto are creating products to sell it, hiring experts, and allocating billions. The reason? Spot Bitcoin ETFs. Regulated, familiar, and easy for Wall Street to access. Now, Bitcoin is mainstream, appearing on major news networks and in diversified portfolios. The conversation isn't if institutions will adopt Bitcoin, but how fast. This isn't just about price, it's about a fundamental change in how the world sees Bitcoin. The code didn't change, but the tools did. Bitcoin ETFs built a bridge between traditional finance and digital assets, legitimizing crypto for regulators and investors alike. That bridge is now crowded with Wall Street's biggest players, reshaping the entire market. The story of 2025 is about who's crossing that bridge, and what happens next. So, what's a Bitcoin ETF? An ETF is a fund you can buy on the stock market, like a share of Apple or Tesla. Now there's one that holds real Bitcoin. When you buy a Bitcoin ETF, you own a piece of the fund's Bitcoin, but not the Bitcoin itself. Think of it like buying a slice of pizza instead of the whole pie. The fund handles storage and security. This is huge for institutions and regular investors who don't want to deal with wallets or private keys. The ETF manager takes care of everything, using top-tier security. You buy and sell shares through your regular brokerage, and the price tracks Bitcoin closely. It fits right into your retirement account, next to your other investments. This simple packaging made Bitcoin accessible to a whole new wave of investors. No more technical hurdles, just a familiar regulated product. That's why ETFs changed the game. The SEC's approval of spot Bitcoin ETFs was a watershed moment. For years, institutions couldn't touch crypto. Too risky, too unregulated. ETF approval tore down that wall, letting trillions in institutional money flow into Bitcoin. In months, billions poured into these funds, with giants like BlackRock leading the charge. This wasn't retail hype. This was real, sustained institutional demand. Even a tiny allocation from a pension fund means billions for the market. The result? Bitcoin's price and legitimacy soared. ETFs gave Bitcoin a regulatory stamp of approval and a place in the global financial system. The floodgates are open and finance will never be the same. Institutional money is changing everything about Bitcoin. The market is less wild, more disciplined, driven by research, not tweets. ETF trading happens during stock market hours, creating new price patterns. The language has shifted from HODL to portfolio diversification and inflation hedge. Institutions bring robust infrastructure options, futures, and secure custody. Research from Wall Street firms is now shaping the conversation. This makes Bitcoin more stable and attractive to conservative investors. But some early adopters worry, is Bitcoin losing its soul? Centralized influence and corporate culture are creeping in. The suits bring stability and capital, but also their own rules. For everyday investors, Bitcoin ETFs are a game changer. Now you can buy Bitcoin exposure through your regular brokerage. No wallets, no exchanges. It's easy, secure, and backed by trusted financial giants. ETFs remove the fear of lost keys or shady exchanges. But there's a trade-off. You don't own the actual Bitcoin. You can't send it, spend it, or hold it yourself. Convenience comes at the cost of control and privacy. Your investment is tied to stock market hours and subject to traditional risks. Regulation means your transactions are fully transparent. For many, the ease is worth it. For purists, it misses the point. The choice is yours. Convenience or true self-sovereignty. The institutionalization of Bitcoin is accelerating. New products, options, leveraged ETFs, multi-asset funds are on the way. Advisors now routinely recommend Bitcoin as part of a diversified portfolio. This could bring more capital and stability, making Bitcoin digital gold. But there's a risk. If a few ETF providers control most Bitcoin, does it lose its decentralized spirit? Satoshi's vision was peer-to-peer money, not Wall Street vaults. The future may split institutional Bitcoin in corporate hands and original Bitcoin for those who value self-custody. Bitcoin's strength is that it allows both worlds to exist. Is this mainstream embrace of victory or a Trojan horse? The answer will shape the next chapter of crypto.